So at the time of this recording, I've yet to invest in any pure play MJ stock because I've always just kind of seen the whole sector as being too risky with sky high valuations among the majority of those stocks. And by the way, in this video, I will be using code words like MJ or CAN because YouTube is very strict with those kind of words on YouTube for some reason. But as I've said before, if there was one MJ stock that I was forced to buy into, one pure play MJ stock, I would probably go with Aurora. Ticker symbol is ACB because I just see them as being either the market leader or at least a very top competitor, not just in Canada, but also across the globe. Unfortunately for any ACB investors though, the stock just won't stop crashing. And when looking at their last earnings that they reported, I think on Thursday in after hours trading, the stock started to crash, and then the next day it dropped by like over 17% on Friday. It was the worst trading day for the stock in over the past 5 years. And then I was working on this video over the weekend. Usually takes me like a couple days to work on my videos, but I was pretty much ready to go this morning on Monday morning, and I was going to get everything kind of finalized and upload the video. And I saw that the stock dropped another 8%, and I was like, okay, I gotta go back and update everything because this stock just continues to crash by such heavy amounts. But naturally, I've been receiving a ton of comments and messages asking me to give my updated thoughts and opinions on this most recent earnings and why the stock continues to crash, and if I'm ever going to be planning on buying the stock myself. So that's what we're gonna cover in today's video, and I'll also clue you in on why it's just been crashing in general and why it continues to do so up to today. So anyway, I hope you guys enjoy this, but we got a lot to cover, so let's just dive right into this, and let's start by taking a look at the stock. Okay, now the stock is still technically up a gigantic amount over the past 5 years at over a 600% gain during that time. But once we start to zoom in, the story really changes. In the past 3 years, it's only up by less than 30%, and ever since then, it's been really volatile with a few jumps that peaked as high as over $10 a share. However, the most recent performance in 2019 has been disastrous as the stock is down nearly 50% year to date and down even more from their 52-week high, crashing by over 75%. Granted, most people likely didn't buy that high and are still holding, but just in the past week alone, the stock has already dropped by over 30% with a crash of over 7% on Thursday, 17% on Friday after those earnings, and then another 8% today. That's pretty crazy. And by the way, that's a really hard pill to swallow for any new investors in the stock, so I'm definitely wishing them all the best on any difficult decisions that they need to make going forward. In any case, even with all of the heavy crashing, their PS ratio is still pretty darn high at almost 10, which is 73% higher than the sector median, and that's not even trailing. This is actually forward sales that we're talking about, so that just shows you how large the MJ stock bubble was when investor money was flooding into these stocks without really paying enough attention to the valuations. Although to be fair to Aurora, they are actually cheaper than some of the most popular MJ stocks out there like Kronos, Canopy, Tilray, and GW, except for Afria that does actually come in a little bit cheaper. Of course, there are other less known MJ related stocks out there that are actually cheaper, and some are even profitable, like Charlotte's Web, for example, who, according to Yahoo Finance, has a forward P ratio of less than 16, although they're mostly just a hemp-derived CBD player in general. But then there's also indirect plays like Constellation Brands, who owns the North American rights to Corona, Pacifico, and one of my favorite beers in Modelo, and they even pay a dividend. And of course, Constellation Brands is heavily invested themselves in Canopy growth. But going back to Aurora, let's take a look now at why the stock has been crashing so hard this year. And in my opinion, there's really both company-specific issues as well as industry-wide issues that have led to a huge sell-off in the stock, as well as the majority of those other big players in the industry. Well, when looking at Aurora specifically, one of the main issues with them that I've brought up in previous videos is their ballooning share counts that continues to dilute investors. See, one of Aurora's biggest assets, at least in my opinion, is their diversification into the global market. And don't worry, we'll be sure to cover this in the pro section of this video a little later. But the problem is that they've made these expansions by making expensive acquisitions of various companies around the world. And given that Aurora is not a profitable company, company, one of the ways that they've funded these acquisitions is by offering more and more stock to investors. And of course, when you do that, you make the value of everyone's already existing shares drop in value, hence the term share dilution. And that's what this chart shows here, where I listed their outstanding share counts by year. And you can see that just in this year alone, they've already grown their outstanding share counts by another 120%. That's obviously a big deal when you already have a very rich valuation, which, by the way, their trailing PS ratio is less than 15 at the moment, but it was only a matter of months ago that it was as high as almost 80. For context, Tesla, who has also struggled with profitability in the past, has ultimately traded insanely cheaper than ACB on a PS ratio basis, and I actually think that they're a much more stable company with just as much future potential as ACB. But ultimately, that rich valuation for Aurora made it very easy for short sellers to flood into the stock as soon as they saw any weakness. And so taking a look at short interest volume, we can see that over the last few months, around 30% or more of all ACB shares traded in the open market have been sold short, and that's ultimately been pushing the stock down even lower. For context, we all know how much short sellers hate Tesla stock, yet when looking at their short volume, there was only one time this year where it actually popped above 30%, and ever since then it's mostly been trending downward, often reaching bottoms in the low teens. But a big reason why these shorts have been flooding into ACB stock is because of their massive losses that just keep getting worse and worse every year. Here's a chart of their negative free cash flow, and it grew by over 300% in 2017, over 500% in 2018, and close to another 200% even in fiscal 2019. So while I understand that they are still trying to fuel future growth by making investments and spending money with high costs, the reality is that they've yet to show any real improvements in terms of moving towards profitability. And we all know how important profitability has become these days as we continuously see new IPO stocks like Uber, Beyond Meat, and others get completely destroyed by the market for thinking that revenue growth is enough to attract investors this deep in our overall bull market. Still, to be fair to Aurora, it's not like everything is entirely their fault. As the Motley Fool points out, there's been a number of issues across the entire industry that have made it very difficult for MJ producers to sell through their supplies. They note that Health Canada, which by the way is basically the government of Canada responsible for their public health rules and regulations, has done a horrible job of working through backlogs of cultivation, processing, and sales licenses, which has led to long wait times for growers to actually bring their products to market. And they also explain that there's been too slow of a rollout of physical dispensaries, noting Ontario as an example, which by the way ACB also brought up during their earnings call, but they note here that they only have one retail store per 600,000 people, and that's to add on to the fact that we are over a year past the legalization of MJ in Canada, yet Health Canada has still not approved the sale of higher margin products like edibles, vapes, or infused beverages, although that should be coming soon with CAN 2.0, but we'll talk more about that a little later in the video. And just to put a cherry on top of everything, they cite research from Statistics Canada that the black market for pot is close to 50% cheaper than legal sales. Obviously, legal MJ products will sell for a premium because they should ideally be safer and actually be regulated to some kind of standards. But if you're trying to compete in the market with your product selling close to 50% more expensive than someone else, you're going to take big hits and eventually you'll need to lower your prices in order to compete, which ultimately crushes your margins, at least until the government takes a harder stance on the black market and tries to slow it down by scaring buyers into not taking the risk. Ultimately though, these issues in Canada brings me to one of the reasons why I actually prefer ACB over most other MJ companies out there, and that's that they are well diversified into other markets around the world. Granted, many of these issues are not just happening in Canada, but it helps to be able to move your product in other markets as well when specific ones are not performing well, and that's kind of the whole point of diversification. Well, in ACB's case, they've already made 18 acquisitions since 2016. They currently operate in 5 different continents and 25 different countries, and they also control 15 global production facilities, making them one of the largest MJ growers and producers in the entire world, with production capacity of around 150,000 kilograms a year right now, which is expected to climb to over 625,000 kilograms over the next year or two. I believe Canopy Growth is the only other company that even comes close. And ultimately, while the market does look very dark and scary at this time, I think most investors would agree that there is still plenty of future potential in the MJ industry. For example, according to Statista, global can spending is expected to grow from close to $25 billion this year to more than double that amount at over $63 billion by 2024. And again, that's global spending, and I don't see any other player that is as globalized as Aurora. Not to mention that there's a ton of opportunity in hemp-derived CBD products as well, given that it's already legal in the United States with only a few exceptions, and that's a market that is already estimated to be worth over $5 billion this year after having grown by 700% year over year, and is still expected to grow to almost $24 billion in 2023 with compound annual growth in the triple digits at over 100% a year. As a result, Aurora made it a top priority to either acquire or partner with hemp-focused companies like Hempco Food and Fiber, AgroPro, Boreal, Radiant, and ICC Labs, just to name a few. In total, Aurora believes that across medical, consumer, and wellness markets, their total addressable market will grow to over $200 billion, which is pretty crazy considering that they only did less than $200 million in sales in their last fiscal year. However, that was still growth of over 300%, which is expected to grow at a much slower pace in the future, but still be around 75% growth this year and another 85% growth the year after. Still, we know that earnings really disappointed Wall Street and sent the stock crashing. So let's go ahead and finish up the video by taking a look at those earnings, and I'll give you my overall conclusion on the stock and let you know if I'll be buying anytime soon. Okay, so again, the stock got crushed, dropping by close to 20% after those earnings, which was the worst trading day in over 5 years for them. And this was a result of their revenue dropping by nearly 25% quarter over quarter, although I should state that many of the articles that I read online only stated their performance quarter over quarter, but would not list year over year for some reason. And when I went into their investors relations page, I saw that sales did in fact drop quarter over quarter by 24%, along with gross profits dropping by 20%. But year over year, these were actually gains of 153% and 274% respectively, although I'm guessing that these reports are probably leaving this out because of acquisitions, but I'm not really sure, to be honest. And even in their earnings report, Aurora seemed to focus much more on quarter over quarter figures. Although I'll just add that they did see double-digit growth internationally, even quarter over quarter, which in my opinion shows the benefit of being diversified. Still, revenue missed expectations by around 15 million Canadian dollars, while their EBITDA loss of nearly 40 million Canadian dollars was close to double the amount that analysts were expecting. They also mentioned that international investments will continue to weigh on profitability. And as a result, they also announced plans to cut spending and either canceled or delayed plans for multiple facility expansions, while also converting 155 million Canadian dollars in debt into shares in an attempt to conserve cash, which I'm assuming will only add even more to their share dilution. As a result, an MKM Partners analyst who has a sell rating and a $3 price target said that if Aurora is less eager to deploy capital to this industry, then investors should also be reluctant to invest in the company, while a Jefferies analyst said that he expects a write-down on goodwill from the MedRelief acquisition. And by the way, that's another huge concern for investors, as you can see here that they have enough current assets to cover current liabilities, and the same goes for total assets versus total liabilities. But what you have to pay attention to is that massive amount of goodwill that they're counting from all of the acquisitions that they've made. Technically, goodwill gets counted as an asset, so you're seeing it included in that total assets category, but I actually never take goodwill seriously because it's not an actual tangible asset. In my opinion, it's more of an accounting trick to make your balance sheet look healthier than it really is after making such big acquisitions. And the problem with that is that if you overpaid for those acquisitions, or the companies or your brands don't perform as well as you expect them to in the future, then their value is lowered and you have to reflect that in the balance sheet, which leads to massive write-downs. And the usual result is that the stock gets crushed. You might recall that something similar happened with Kraft Heinz, who took a massive write-down for some of their brands like Oscar Mayer, and the stock obviously got crushed as a result. But back to those earnings, that same analyst actually has a buy rating and a $7 price target, but even he's starting to turn bearish, as he noted that with cash pressures evident for the company to announce the cease construction of new expansions, despite a press release from just 6 weeks ago praising progress being made, and now positive EBITDA looking unlikely for the year, it's fair for investors to no longer trust this management team. Still, others were more positive, like this analyst from Cohen, that praised management's decision to cut capital spending in order to match up supply capacity with the lower demand that is resulting from the tough environment. But again, their higher EBITDA loss for the quarter is mostly signaling that they're not really moving in the right direction in terms of becoming profitable, and the management team blamed the poor results on the market and on increased spending, citing an inadequate number of retail MJ stores in Canada, which is something that again we talked about earlier in the video. As far as what the bulls are arguing, well, they feel that cutting costs is the right move right now because of the weakness in the market, and they're looking forward to Canada's Can 2.0 that will lead to the legalization of edibles, vapes, and beverages, where Aurora is hoping to be a top competitor with new products like vaping pens and even chocolates. And we know that Aurora is working on different ways to expand their reach into the US market as well, but it's just going to take time until we really see how all of this plays out. Now, as far as how I personally feel about Aurora as a company and the stock, well, I still think that as a company, they will be one of the market leaders in the future. But as the stock goes, I think it could be several years until they really grow into their valuation. And that's kind of a problem for me because given how far we've gone in this kind of bull market, whatever you want to call it, I've just been focusing a lot more heavily on valuations, profitability, balance sheets, and even dividends, which are all things that are not really on the positive kind of side of ACB. Now, I am still definitely consider myself more of a growth-oriented investor. So from that standpoint, it would make sense to pick up ACB at this point, given how much they've crashed. I gotta admit, they are starting to look very attractive to me, and how heavily they're shorted. If they were to announce a partnership with like Coca-Cola for some MJ-infused beverages, I would not be surprised at all if the stock really shoots up and we see a short squeeze. And I actually think I have a little bit of a gut feeling that we might see a rally with MJ stocks at some point because they've just been crashing so heavily. But I'm still just kind of sticking with my original thesis that it's still a stock that is valued a bit too high along with the rest of the MJ kind of market. And so for those reasons, I think I'll just continue to sit this one out. It's very tempting, and if I really wanted a pure play on the MJ market and I really believed in Aurora and I didn't mind picking up another spec stock at this time, right now would actually seem like a good entry point to me. But given that I'm not someone who really feels like I need to own an MJ stock at this time, it just doesn't make sense for me to take the risk. So I'll continue to stay on the sidelines for now, but if I ever do change my mind, I'll definitely give you guys an update video and let you know if I do end up buying ACB. But I would just like to see them make some progress towards profitability before I'm really willing to make it into an actual long-term investment. As of right now, I still see it as a speculative stock because they continue to lose so much money. So anyway, that's just my opinion though. Doesn't mean I'm right or wrong. It's just my opinion. I would love to hear what you guys have to say. Let me know down in the comment section. Are any of you invested in ACB, or are you looking to pick up shares now that they've dropped by so much? And I gotta admit, they are starting to look very attractive, but just for me personally, I'll continue to stay on the sidelines just for now at least. But anyway, thanks again for watching the video. I really appreciate it. Make sure you hit the like button if you enjoyed it, and I'll catch you guys in the next one. Thanks again. Take care. Bye-bye.